For those of you that have not been on this call before, we've been doing this since COVID. COVID obviously changed the way that we communicate. For those of you that don't know me, I'm a financial advisor, have been in the business over 30 years now. And I felt that, you just can't, wait around for things to change. So I started doing a weekly call on different topics. I try and bring value back to the community, trying to share insights, part of my experiences, just ways to be able to take sometimes complicated information or maybe some of the data that we're getting from the media and help us to interpret it more on a non-emotional level. So one of the things that has come up is that we do a recap, almost like a Monday day quarterback, hindsight 2020 type review of the past month's performance and then a year to date. So although it says January 2022, obviously January has not passed, this data will be from December. We also, sometimes I have other advisors on here, or they will also are allowed to invite their clients. What I tell everybody on these calls, nothing will be sold here. We're not here trying to, get you to break out your credit card or your checkbook. So we just really want you to relax, take some notes. And if you do have questions, feel free to circle back and we'll answer them to the best of our ability. So without further ado, these calls typically today will probably be about 15 minutes. I keep them short and sweet because I know you're busy and I want to make sure that I just bring value and not bore you to death. So, December, this is the equities market, and there are some squiggly lines on the page here. And if you look here, you'll see that they're color coded. So, from left to right on the top of the screen, we have red, which is the S&P US equities. And then you have blue. So you have large cap is red and blue is small cap, so smaller corporations. And then you have green, which is your developed countries, typically Europe. And then you have a hot pink, which is emerging markets. I typically refer to this as China, Indonesia, a lot of places where typically new businesses would be challenged. Then you have commodities, real estate, and then, gold, right? So, whether that be in the form of an ETF like the spiders here. So on a snapshot in the month of December, anything above the black line means positive gains. And you know what? December, for, coming off the second year of COVID here, actually seemed to do pretty well. So as we take a sort of a more of a macro view, we focus out a little bit and look at it year to date. Remember, this will be the entire year of 2021. How did it look? Well, now we have a lot of data all over the place. But for the most part, the two areas that did the best for 2021 were actually commodities. So your oils, your precious metals, things of that nature. And then you also have some real estate, right? Which makes sense because I think everybody knows, I've seen and had quite a few of my clients have sold property, cashed out and moved elsewhere. And what they're getting is above asking price. Houses are not on the market long. And I think people that are have invested in real estate, where real estate the year before was not the place to be. So it just makes sense. I mean, but there are very, very healthy returns there. But the US economy, the S&P, the blue chips actually did pretty well. And then you had the small caps. So overall, when you look at equities, and this is why we've been saying, equities are an area that we like, even on a go forward basis. So you'll see by the end of today's presentation that, there is maybe a little bit of concern coming up in about 3 or 4 months, right around mid-year, where we think we might see a pullback. Some of the NASDAQ started to drift into correction territory. So we're constantly measuring what's going on, because what we don't like to do is make knee-jerk reactions. That overall planning is about strategies and committing to a strategy that you're comfortable with. And typically that's defined as asset allocation, right? So maybe it's 60% equities, 70% equities. The area that we get a little cautious in is the bond arena. And I've been talking that ad nauseum, 2, 3, 4 years now, bonds, be careful, but we'll get into that in a second. But as we look at the, European nations, right, developed countries, everything did well. The two areas that did not do well for the year were gold, but that was after gold had a tremendous run in 2020. It just makes sense that it fell off. People started feeling comfortable again and said, hey, I want to be in the market. That's where we got to get a rate of return. And then, China, emerging growth, not the place to be right now. Doesn't necessarily mean that from a forecasting standpoint that's going to be the case on a go forward. But, that sort of follows right, in step with what we've been promoting and just being cautious with the international marketplace. Now, this chart here, if you're not familiar with it, there's three indicators. The relative strength index is on the top. In the middle is the moving average crossover. And then you have on the bottom indicator is the MACD, is moving average convergence divergence. Very technical terms, but really it's a simple calculator, sort of analytical tool that we drift towards to see what are the signals telling us. So think about it as being in an airplane, right? And we have alarms. And if there's storm clouds ahead, we have radar ahead, we, barometric pressure, altimeters, right? So whatever the gauges and indicators are, this is sort of three of them that can give us, if three of them trip, then they will create a red line vertical from top to bottom. It is by no means is that guaranteed that that's going to happen. And as you can see here in 2020, we had a head fake. When COVID hit, we saw that, hey, things could turn around and the bottom could fall out. It did not. It turned back around. And a lot of our clients, we said, hey, we actually think you should still be in the market. And it has continued on an upward trend. Right now, there is nothing that has tripped. So there's no cause for panic. Investing for retirement and into the future is a longer term goal. And so it just should be introduced or practiced with a strategy, as I mentioned before. So this is, like I said, one of the indicator or the charts that we call the three wise men that basically say, hey, do we see any storm clouds that we should be aware of? And if we do, believe me, we're going to bring this to your attention. We're going to be sending out alerts to our clientele, email blasts, and obviously on calls like this. Now we're going to switch from equities to the other area, which this here has been a problem, and again, we've talked about it in the past, which is income. So when we think about income type vehicles, right, bonds generate incomes, they're debt instruments, and we're looking to capitalize on the coupons that they generate. Agreements that were made, right, by corporations or, government entities to be the promise to pay a rate of return for borrowing money, and then at the end of that period of time, return your principal. Most people are not holding bonds. Most people are holding bond funds. So quite often what they don't understand is that, hey, listen, although your risk assessment, risk questionnaire, it's called an RPQ, risk profile questionnaire, says that you are probably comfortable with a 60-40 allocation or a 50-50 allocation. I have cautioned and asked that a little bit of a second look be taken, right? Because are you comfortable in losing money in a bond portfolio? You go, well, how is that possible? Well, bonds don't like rising interest rates. And I can bet if I were to ask every person on this call, have you heard the topic of inflation thrown around the media of late? And it is on every channel, right? If you're not experiencing that personally, either at the pump or in the stores, when you go to buy, consumables, you're certainly seeing it on TV. So if inflation is in fact here, and it's not just a short-term problem, but more of a systemic or a longer-term problem, we should be careful of having an overexposure to bond type vehicles. So on the month of December, if we just look at the blue line, which are high yield corporate bonds, and then we look at the teal line here, which are high yield muni bonds, those are really the only two that made any money. Now, if you've retired and you're on some type of income stream desired need, right? You basically said, hey, I'm no longer working. I need my portfolio to generate and fill some of that income gap between my Social Security and my pension. And here's my living expenses. I need X. And if X is not providing, we have a problem. And that's where I think a lot of people are under a little bit of a misconception that bonds will always provide income. Although the promise to pay will be there, the value of the underlying bond, quite often, we don't hold the bond. In order for us to get a return of principal, we have to hold it to maturity. But then we also could have the problem where the bond, if we're in a bond fund, where the money managers are basically saying, hey, I need to sell this bond to be able to pick up another bond, we could actually lose money in our portfolio. So on a month to month, this is just sort of, it's negative territory for a lot of the bond funds. But let's look at it for the year. Now we start to see a real problem, which is, hey, bond income for the whole year, I needed my $1 million portfolio to throw off 30 or 40%, right? The 4% rule, which was, considered gospel in the late 90s, in the 2000s, has now been since basically challenged and even disproven. So if 4%, you needed 40 grand out of your portfolio for your portfolio never to run out of money, and lo and behold, the portfolio lost 2% on $1 million. Well, now we're not at $1 million anymore. So not only are we not getting the revenue, right, but we're also, the value of the bonds has gone down, and that lies the risk. So everybody, and you've heard me talk about it, is chasing, the entire world will be chasing yield. But when we use the word high yield, we have to substitute those words with junk. Right? High yield means junk bonds. And, if you're putting your money into junk bonds, it just means higher risk, either less credit worthiness or slow to pay. Right? So there's just a combination of risks that part of what we're doing from an investment platform and an investment strategy is to find bond alternatives, things that can help us to reduce some of this fluctuation. And this is the other thing I want you to look at, is look at some of this, back in March of last year, all of the bonds, right? These are big sell-offs. So in your portfolio, not only did you have to get there, but you have to recover. When you're working and you're dialed in, but this is where I talk about target date funds, right? Target date funds are supposed to be on autopilot. But predominantly, if they're following traditional wisdom, as you get closer to retirement, and okay, you're supposed to take less risk, therefore let's be more in bonds, by default, they're designed to fail. And that's why I'm always cautious to people that have a heavy exposure to bonds, bond holdings, bond type funds, because I don't think that people fully understand the risks that they have, especially at a time in their lives when they're approaching retirement, where they really can't afford the losses. So a similar graph that we have here on the bonds, we still have a green line here. So we do not have anything telling us to sell yet. But I've been cautious, right? It was close here last year. We have one crossover on the MACD at the bottom and a crossover here again in the moving average, 90-day moving average. So, but we're not overbought, oversold yet, right? So it's 3 out of 3 have to trip in order for us to get a red line, which means we might see it falling off. So the sky is not falling, right? We're just constantly looking at this saying, hey, how can we interpret data without making emotional knee-jerk reactions so that we can get a reasonable rate of return with the least amount of risk? And that's typically the goal that we're trying to have, achieve for folks. So lastly is an index or an indicator that was created by Formula Folios and now Brookstone. It's called the Recession Probability Analytics Tool. Right. And basically they have 100 data points on different areas, right? Whether it be the, domestic gross product, whether it be debt to income ratio, there's just a significant 100 different variables that go into this tool that says, hey, you know what? We see a recession looming. And although it ticked up last month and it ticked up again, we are still below this 50 percentile. So nothing is jumping out at us as saying, oh my God, the sky is falling. So this is where, part of the reason I do these calls every month is so that we can sort of, as much as we see sell-offs in the market, like last week, like we see this week, right, or today, right, we see a lot of volatility. Volatility is here to stay. But if you're making I got to get out. I have a bad feeling. This is going to happen. I heard this guy say that, right? It's not really a prudent approach to investing, right? That's where strategies come in. But if there was something, a storm was brewing, I mean, we would definitely be, hey, listen, you know what last year when COVID had hit and we had that sell-off, our recession probability analytics was up around above 60, almost 70. And then it started to drop back, right? Because all the fundamentals were there to say, hey, listen, this is just a short-term correction. So, and that in fact turned out to be true. So again, I don't have a crystal ball. I'm just going by the data, how I look at it, but the people we talk to and talk with. And as I see information come across my desk, and then I share that with you, that we're making informed decisions. So that's the end of our call. If you need me, please reach out. I want to thank each and every one of you for taking time out of your day every week to hop on. Hopefully I continue to bring value. And then the last thing is, if you know anybody that you think should be on this call, please invite them, right? I mean, it's just, as you can see, it's just an area where we can convey information to you in a way that we think is unbiased, right? So hopefully this continues to bring you value. I hope each and every one of you is safe and sound. And if you need me, give me a call. Have a great day. Bye-bye.